Hi, Lynn. How are you?
Good. How are you?
I'm good. Missed you last month. How was your holiday? Looked like you had a nice break.
Yeah, it was good. I tend to go to Egypt every autumn to visit some family and friends. And so it's like a workcation. Like I was still working while I was there, but I wasn't doing interviews, partly because the internet's not great, but also partially to cut down on time.
Well, you deserve a break. You sometimes have to have a break. I went away with the kids earlier this year, and I made a promise to them I wouldn't work, and I managed to do it. I had 2 weeks off, apart from arguing on Twitter. So you deserved a break. It looked like you had a nice time, though. Um, right. Well, in the time since we last spoke, the world seems to be getting madder and a bit more crazy. I have no idea where we're going, Lynn. There's lots of weird stuff happening today. UK fuel prices are at their record level. Reported at, I think it was actually, I just tweeted about it. I think some people misunderstood my tweet, but it's an average of £1.43 a litre. And to translate into American prices, that would mean an average of $7.45 per gallon, which is pretty high. We've also had a number of energy companies go into the wall. Supply chain issues seem to be everywhere. What's going on, Lynn?
So I would say it's a couple things converging together. I think it was I think it was our first podcast together where I talked about the long-term debt cycle
Uh-huh.
and that whole kind of idea playing out. And so I use that as like my big foundation for what's happening is essentially that, you know, basically so much debt is built up in the global system, especially among developed markets and China. And there's so much public debt, so much private debt. Interest rates are near zero. And so when there's a recession, when there's some sort of like impact to the economy, they can't really raise rates any lower. They're already about as low as they can get. Some places even negative. And so instead, they come in and they do large fiscal stimulus, which can boost demand, so everyone can go out and buy more goods and services. But the supply of some of those goods and services is still constrained. And then the issue is when you expand the money supply like that through that fiscal spending, you can't really raise interest rates too aggressively because you already have so much debt in the system. And so they kind of have this period where inflation runs way hotter than interest rates, and so currency gets devalued, and you risk running into pretty significant inflation, pretty significant shortages. And when you combine that with kind of the 15-year commodity cycle, so people, investors go through this period where commodities are scarce, they're very expensive, and so tons of capital rushes in to find more commodities, and that eventually oversaturates the market because there's no pricing power. And so eventually you kill the price of those commodities. And then there's, they're super cheap, and then there's nobody wants to invest in them. But eventually that excess supply works itself off, and demand keeps kind of eating away at it until eventually you start to run into scarcity again, and you drive the prices up. And historically, that's happened, every 2 decades or so. It's kind of a long-term cycle. And so for the past 10 years, we've been in this very commodity abundant period. And that's starting to change here in 2020, 2021, where especially we have not invested very much in energy after both a long bear market and for various ESG mandates out there. And so different markets are kind of starting to feel some of the consequences of that.
What's this long-term 15-year commodity market? Sorry, commodity market. I've not heard you talk about that before.
Yeah, so basically it's the idea, to quote natural resource investor Rick Rule, bear markets are the authors of bull markets, and bull markets are the authors of bear markets in the commodity space. Because you're in an industry where your product is not unique. If you're a copper miner, you're selling the same copper that anyone else is, so you don't have control of your own project. You can only control your capital costs and your investment decisions about when to make a new mine or when not to. And so when commodities are super cheap, and you can't really make money by building new mines. It's too risky. It's just not really profitable. There's not a lot of new capital comes into the space, so no one really builds new supply. And eventually, after a long enough time, I mean, the existing mines get drawn down. They don't put new money into expanding them, and demand usually keeps ticking up over time. And so eventually, that excess supply works itself off, and you start to get actual scarcity, and that drives the price up. And then because those mines often take years to bring online, it's not like an immediate function. It's not like they can just snap their fingers and make more copper. And so you usually go through this period where copper prices, for example, are very, very elevated. And that gets worse and worse until it keeps attracting more and more capital to come in and find and build new copper mines to eventually alleviate that and kind of start that cycle over again. So that ends up being a very long-term capex cycle, and it applies to most commodities. It's applied to copper, oil, gas, uranium, agriculture, but usually agriculture is on like a quicker schedule because it's easier to rotate crop seasons than it is to build a copper mine, for example. And so one of the issues is recency bias. So investors and policymakers look back over the past, say, 5 years, 10 years, and say energy is abundant. We have nothing to worry about. We don't have to keep investing in it aggressively. But the problem is that by doing that, it becomes self-fulfilling, where we eventually have, basically a commodity surge where we've underinvested in a lot of these things. And then if we still are kind of in the mindset where we're not going to invest in them, that they prices can get pretty high and persist for a while. I mean, it might not be a straight line. Some of these parabolic spikes, especially what we're seeing in Europe, might cool off at some points. But I think that this is going to be a big story for the 2020s, where we've not brought a lot of new energy supplies to market over the past 5 years.
Okay, we'll come back to energy in a moment. I just really liked what you just said there, that bull markets are the authors of bear markets and bear markets are the authors of bull markets. I like that, just thinking about Bitcoin, because one of the things I've realized during this bull market is I actually prefer the bear market in some ways. It's a lot easier to get work done. And actually, that's the period where you define how you're going to perform in the bull market in terms of what you've built as a business and whether you've had the ability to, say, stack yourself some sats for going through that market. That's super interesting. Okay, let's talk about energy then. You talk about investment in the energy market. I feel like, having spent a lot of time with some Bitcoiners and speaking to various experts in the energy market, there seems to have been a pullback with regards to nuclear and a push for green energy, but it feels like the green energy markets themselves are, I don't even want to get into are they actually green because of some of the waste in the production, but it feels like that nuclear is it's the most forward-thinking technology. That's the most evolved technology we have. But there's been a pullback. There's been a lack of investment in that. Is that what you're referring to?
Well, I was mostly referring to oil and gas, but we've had a similar
Okay.
thing. We've had a similar issue with uranium, and so with oil and gas, that's more mainly about that we've not put. We've have. It's kind of like we're trying to phase out the old technology before getting new technology in place that actually fulfills all the same needs. And so we don't have, for example, grid level electricity storage that's affordable and that's kind of widespread, that would make solar and wind more competitive. So they can be used for a percentage of the grid, but once you start using them for more and more of the grid, you start to run into intermittency problems. You don't have that
Okay.
reliable baseload, and so they need some sort of energy to bridge that gap. And so it could be coal or natural gas. Obviously, especially coal has environmental downsides, puts particulates into the air, which are known to be poisonous, especially when they're concentrated.
I
Uh,
think it just came out today, Lynn, that there is more carbon. It's record carbon in the atmosphere.
yeah, that's generally been a trend going up for decades now. And especially the past several years, they track that pretty regularly. It's kind of up and to the right, and so one of the arguments for nuclear is that basically you get uranium, which is still there's still commodity input, but it's pretty abundant, and you put that you basically do a lot of capex. So for nuclear, you know the uranium is a smaller percentage of the energy of the cost compared to the large infrastructure required to build those nuclear plants. And so you build those nuclear plants, and they can last. I mean, they originally lasted for decades, but the newer technology, a lot of those are they're extending their lives. They can go for 70 to 100 years of that plant being in operation, and it provides very clean baseload power. No carbon emissions, no particulates into the air like coal. And so the big downside is that over the past, say 5 decades that technology's been in place, 5.5 decades, really is that there's been those three notable disasters, you could call them. So there was 3 Mile Island, which was in the United States, and that was the least bad of the ones. That one was kind of like there was a radiation leak. It was a less severe one. Then by far the most damaging one was Chernobyl. In the 80s. So 3 Mile Island was the 70s, Chernobyl was the 80s, and then of course Fukushima in
Hmm.
2011. And so there's a couple things worth noting about them. One is that, so you had a number of dozens of maybe actual casualties from the disasters, but then you have a very hard to calculate number of people that are impacted by radiation over the next several decades, especially from Chernobyl. And then we don't know, of course, Fukushima. That's still playing out. That could still play out for decades. But even the high end estimates are fewer people killed than die estimated from coal worldwide every single year. So it's kind of like the math of airplanes, where statistically flying an airplane is very, very safe. It's much safer than driving a car a long distance. But every once in a while, you get one of these high-profile crashes, and then so people think of, say, airlines as unsafe, whereas in reality, it's the way that that's distributed is nothing happens 99.999% of the time, and then something dramatic happens. But when you add all those up, it's still way safer than car. And another key point is that even though those disasters happened in different decades, they were all built in the late 60s, early 70s. So they were all that like 50-year-old technology. And we've, ever since, 3 Mile Island and Chernobyl, the world has not really, we've not put our best into nuclear. We've, that energy growth kind of flatlined, and not a lot of people went into researching it. And so we kind of stalled in that area and folks in other areas. But I started writing about this last year, and it's one of those things that it became relevant faster than I thought it would, because now in 2021 we have some of these energy shortages, especially in Europe and China, and people are kind of turning back towards nuclear to some extent. The narrative is shifting a little bit because it really is one of the best ways to have fairly clean energy that's reliable.
On the nuclear side of things, I recently spoke with Harry Suddock. He was talking about new generation 4 reactors. I'm not sure if you've looked at that. And also, I've seen been a breakthrough in fusion. So there was like an MIT project that achieved a major advance towards fusion energy. So it feels like stuff is happening, but we are way behind where we need to be because we're having energy issues in the UK. I think there's been blackouts in China, in India. There's the issue with the grid that happened in Texas. Do you have you looked much at these Type 4 nuclear reactors?
To a moderate extent, it's not my key expertise, but essentially, the market can shift towards these smaller nuclear reactors. And so historically, there were all sorts of security concerns around having smaller and more widespread nuclear reactors. And because of the capex and the regulation, it was more cost effective to build a very, very giant nuclear reactor.
Right.
But theoretically, having these smaller ones can be very useful. And then, of course, there's new generation tech out there. There's also ones that are using technology that is actually pretty old. It just hasn't been used, and so they're kind of pulling some of those technologies out of the dustbin and kind of dusting those off, and then kind of looking into how they can apply those as well. So it's really a underexplored field because it's not something we've aggressively pursued. Whereas, for example, semiconductors, we're throwing our best at it. We're constantly iterating, growing that area very quickly. Whereas nuclear, it's just for example, the number of people going into nuclear engineering as a field in the Western world is minimal, and so it's just not been a big area of investment. But I'm optimistic.
You're optimistic. Well, but you think energy is going to be one of the big topics of, I guess, the next decade, where we source our energy from, and how tied it is, I guess, to the global economy. Because if fuel prices are going up, air travel will get more expensive. I assume that's going to be linked to containers being more expensive. Actually, and I think I read about this. I also think I saw you tweet about this. Specific companies have stopped certain production just because energy is too high. Isn't there like a Dutch steel plant that closed
Yeah,
down because energy?
that was aluminum, and so aluminum is a very electricity oriented metal to produce to refine that. And so it's funny because that's often been compared to Bitcoin, where if a country has a ton of excess electricity, one of the things they can do with it is refine aluminum because it's so electricity intense. But the counter of that is if you're an aluminum plant, you're one of the first things that has to kind of shut down if electricity costs are very high, because electricity is a very big part of your expenses. And so aluminum makers have kind of faced some of the brunt, but it's other manufacturers as well. Anything that's kind of marginal and uses a lot of electricity, if electricity spikes, some of those marginal ones start shutting off their demand, and so that can help supply and demand, but also can hurt the economy because that'll show up in GDP and show up in kind of say you could get an aluminum shortage, for example. I haven't closely covered that particular market in a while, but for example, as different manufacturers shut down from electricity costs, then you can get higher inflation in some of those physical goods because you have a cut to supply while demand is still pretty persistent.
So, do you think these energy issues are transitionary as well, or do you think we've got other major headaches ahead? Because a few of the things that are concerning me, I mean, just filling up a car of petrol in the UK, I mean, that's pretty expensive. That's going to cause a lot of hardship for certain people. And I also think going into winter, and maybe not even this year, maybe next year, because I think the UK regulator is going to have to up the cap for energy prices. And with everything else getting more expensive, but real wages not increasing, it feels like there's going to be a lot of pressure on households and household incomes. Although I say that, I think a note came out that from Rishi Sunak for the Chancellor, he's going to be upping the minimum wage in the UK. So it feels like this may be more of a squeeze on the lower middle class.
I think so. My view is that the energy narrative is going to be with us for the decade, meaning that 2010s was all about abundant energy. 2020s is I think going to be a much more scarce energy or high price energy environment. Now, that'll still probably come in cycles because if energy prices get high enough and it starts hurting demand because people can't afford it, and if it causes governments to try to temporarily tighten either their monetary policy or their fiscal policy to rein in that inflation, that can temporarily put the economy into a recession because you can hurt demand, and so when you hurt demand, that can pull down energy prices, but then they end up stimulating again. And so then we go into the next cycle. And so it won't be a straight line. I would kind of fade these kind of parabolic spikes that you might see in, say, natural gas prices in Europe or coal prices in China. Because if price goes up high enough, that can kind of bring on excess supply for a period of time. And also there's that function to potentially cut demand. But I think it's going to be one of those things that the overall trend is going to persist with us for a while because we have not invested much in it, and how severe it gets partially depends on how fast people are allowed to respond to it. If you keep kind of disincentivizing investment in some of those, then that can keep the pressure up for longer. Whereas if the market is able to come in and kind of make all those new supplies, then that can make it so that I think that still the 2020s decade will have, say, higher energy prices than the prior decade, but they might not be as crazy as they otherwise could be.
What are you tracking with regards to inflation right now? Because I know the inflation rate in the US hit a quoted 5.4%, I think it was. The Bank of England has just warned that UK inflation will hit possibly 5% or more. They think early next year. I think we've just had 3.4%. We just had the biggest rise, month-on-month rise, I think, on records or something. Also, nobody seems to agree with or trust these figures. Preston Pish, our mutual friend, he says, I think he says recently, most of these the inflation rates are probably 3 times the quoted amounts. What are you tracking or seeing with this?
So lately, I've been focusing a lot on rent inflation and owner's equivalent rent inflation. So in the United States, we used to include housing costs as part of the inflation basket. But then they eventually took those out because they are classifying those as a capital asset rather than measuring consumption. And so that's been a controversial change to the CPI calculation because if you know, housing prices soared over the past year, and so if you still included that in CPI, we probably would have low double-digit inflation in the United States. But because those have been removed, it's not really, the actual headline number is somewhat lower. And so when you go back and look at those, instead, what they put into the index is owner's equivalent rent, which is kind of a wonky way to, include housing indirectly. Owner's equivalent rent and rent together are about a third of the CPI basket in the US.
What is
And
that? Sorry, what is owner's equivalent rent?
so what they do is they basically estimate the monthly cost of owning a home, living in that home. And so basically, it's kind of a way to include your housing costs going up without actually including whatever the price of the house is doing. So it's kind of the smoothed out lower version of what's happening with actual housing prices. And so there are some periods of time where that outpaces housing prices, like when the subprime mortgage crisis happened and housing prices fell. They fell a lot more than owner's equivalent rent did. But on the other side of that, when housing prices go up very, very quickly, that doesn't really get reflected in owner's equivalent rent for a while. And in addition, owner's equivalent rent indirectly takes into account the fact that interest rates are lower. So if housing costs go up dramatically, if the price of a house goes up a ton, but if interest rates are lower, like if mortgage rates are lower than they were 10 years ago, then your monthly payment might still be roughly the same. And so that housing inflation won't show up in that owner's equivalent rent calculation. And so when you look at, say, you know, rent information, like rent price increases over the past year or two from, say, just companies that focus on that, they're pretty significant. They're double-digit price increases. Whereas when you look at rent in the official CPI, it's somewhat lower than that. And same thing when you look at housing prices, they've soared in many areas, but the owner's equivalent rent has kind of been very muted in comparison. But ever since this summer, we are seeing the official CPI calculations for rent and owner's equivalent rent start to turn up pretty sharply. And so that's something I've been focusing on because that's a third of the official CPI basket. That's, a bond market looks at that. All these kind of traditional financial markets look at that. And so that's going to lead to some sticky high CPI numbers for at least a few more quarters.
So how high do you think this could go? Because we used to target inflation rates of around 2%, and I've experienced it creeping over 3%. We're seeing quoted numbers of 5% and plus, which is concerning. If we got to 7, 8, 9, 10, I think that would be very concerning. Amongst what you're seeing, how far do you think this could go?
So there's a couple metrics we can use to look at that. I mean, partially that'll depend on policymakers, fiscal spending, debt monetization, that sort of thing. In general, it's hard for inflation to exceed the money supply growth for a long period of time. That's kind of the core of where price inflation comes from is the amount of money in the system going up. And so in the United States, for example, over the past year, the money supply is growing at about 13% year over year. That's lower than it was in 2020 when you had that gigantic spike, but it's still at above normal levels. In the UK, you're looking at a little bit lower than that, but still somewhat elevated growth levels. And so that doesn't represent like a near term ceiling, but it's hard to have say CPI go above that for a long period of time. And so you can also look at, say, producer price index. And so, if you look at producer prices going up in the United States, somewhere around 8%. So that, if that were to persist for a while, you could see CPI continue to elevate. And so there's a couple key things to watch as far as that's concerned. We also can go back to if central banks try to tighten and try to kind of, kill some of the demand that could kind of temporarily alleviate inflation, but then they start that economic stagnation cycle, and then they probably get into another stimulus cycle. So long term, it'll really come down to money supply growth. How much kind of fiscal deficits happen that are then monetized in part by the central banks of the world, and so that's kind of the overall key driver, I would say. Whereas everything else is kind of around that phenomenon. So we look at, say, energy scarcity, we look at other commodity scarcity, we look at supply chain problems. Well, another way to think about it is over the long run, you can look at that broad money supply growth, and then you can look at CPI growth. And there are some areas where you get pretty high divergence. And so, for example, in, say, the late 1800s United States, you had pretty rapid money supply growth, but you as a deflationary period. And that's because, I mean, we had all this land that we were expanding into. Obviously, the natives, but that's a whole nother story of history. So there's all this land they were expanding to. They found oil. They invented the internal combustion engine. They electrified things. And so between the Industrial Revolution of the UK and then all this expansionary land in the US, you had prices be very, very low because you had massive productivity gains, railroads, things like that. And then similarly in the 90s and the 2000s, we've had another decoupling from broad money supply growth and inflation, and part of that's from globalization. So wage pressures have not kept up with money supply growth in especially the United States, but also in some other developed countries, and that's in part because all that all that extra wage pressure, instead the release valve ends up being either in some cases automation, or especially for the United States and others like outsourcing. And so we've kind of arbitraged the geography a little bit in order to kind of keep wage inflation down, which obviously has all sorts of societal consequences, but also kind of keeps CPI a little bit compressed compared to that broad money supply growth. So the combination of the growth of the internet, growth of offshoring has been a very kind of disinflationary generation. But there's signs that that's kind of topping out. We've seen in 2020, 2021, if you have an extremely globalized supply chain, how fragile it can be. We basically sacrificed resiliency in order to make it as efficient as possible. And we're maybe finding out that was the wrong balance. We went too far in favor of efficiency and less towards resilience. And so I think now there's kind of a bounce back towards resilience. We also, of course, have growing tensions between the United States and China. And so I think that basically this accelerated period of globalization is probably behind us. And so adding to the commodity scarcity, this kind of flatlining or even partially reversing globalization is another inflationary pressure to be aware of.
Can we talk about Jack's tweet?
Sure.
The tweet.
Yeah, the hyperinflation tweet.
Yeah, so he put hyperinflation is going to change everything. It's happening, which I thought was a fair tweet. I mean, it's like 73,000 likes right now, but I mean, I thought it was a fair tweet because it wasn't geographic specific, and certainly, I think it's certainly possible that we're going to see a hyperinflationary event in certain countries. But then he replied to someone, "It will happen in the US soon, and so the world." What is the rate that is considered hyperinflation? Is it like 40-50%?
So it's often considered 50% a month, which is thousands, which is thousands and thousands of percent per year, because you compound that for 12 months exponentially. You need extraordinarily high inflation. So, for example, even the high inflation of Turkey and Argentina is not necessarily considered hyperinflation. Whereas, for example, obviously the Weimar Republic was a hyperinflation. Zimbabwe was hyperinflation. I believe Venezuela classified for long periods of time as hyperinflation. But above a certain point, it almost doesn't matter too much. I mean, obviously there's a difference between, say, 25% inflation in Turkey versus, say, 1,000,000% inflation in Venezuela. There's a difference there. But once you start getting into double digits, inflation becomes obviously a major issue in any market. And historically, hyperinflations tend to happen. There's kind of two big ingredients that go into making hyperinflations happen. So one is some sort of damage to your productive systems. So that can include, for example, in Zimbabwe, they reorganized how they do farming. There's basically social conflict there. That's a very long story, but you had a production collapse, and of course Weimar Germany after World War I. I mean, they were impaired in terms of the damage they sustained from the war and the economic consequences of that. The other big kind of ingredient is when you have liabilities denominated in an asset that you can't print. So in developed markets, they have a lot of debt, but it's in their own currency, and so it's somewhat easier to kind of quote unquote taper Ponzi. You can kind of do that kind of over time. Whereas if you're an emerging market and if you say you owe dollars, right? There's no way that your country can create dollars other than earn them through trade, and so you can pretty easily run into default scenarios and currency collapses. Same thing for Weimar Republic. They owed war reparations that were denominated in gold, and so it contributed to their being unable to service those debts. And so generally in developed markets today, we don't directly see the kind of the ingredients of hyperinflation. But so my base case for a while, the kind of the call that I've been making for the past couple years is that I expect the 2020s to be a pretty inflationary decade. Now, hyperinflation has not been my base case in developed markets, but I don't rule it out as a possibility because after a certain point, if people lose confidence in the system, if they don't want to buy the bonds, and if you start to see kind of a out of control kind of deficit monetization, then anything is possible. And so especially when you combine that with energy scarcity or deglobalization or potentially any sort of black swan event that could occur, like a natural disaster or even some well telegraphed events, like if China ever were to say invade Taiwan, then there's potential war between two nuclear powers. Who knows what could happen there? So there are catalysts that I think could get the world to a more hyperinflationary type of scenario. But it's my overall view has just been focusing on the inflation side more so than the question of hyperinflation.
Yeah, I mean, Jack's tweet you could say was slightly hyperbolic. I I mean, other people would point and say, "No, it's correct. This will happen, or it might happen." But I would struggle to see the idea that the US would enter hyperinflation. But I think, like you said, you can focus on the actual inflation that's happening, or risks of inflation, and as you rightly noted, like Turkey and Argentina are both experiencing very high inflation at the moment, and that has dramatic effects. That has dramatic effects on the local economy and the people who live there. So even if we were to see 10, 15, 20% inflation in the US, the UK, that still would be a very bad scenario for a lot of people, especially if this was something to carry on for a decade.
Yeah, and so one of the big things that I focus on is the fact that because we're towards the end of this long-term debt cycle where they pretty much have to hold rates low despite inflation, because otherwise, the sovereign entities are insolvent. That opens like kind of the possibility of this spiraling out of control. And so, if you want to make the hyperinflationary argument, you basically would go back to history and say that no fiat currencies lasted particularly long. And so the structure that we've had in place since the 1970s, which is that the entire world is on a fiat currency standard, is very unique in human history, and it's only so far a 50-year experiment. And so, especially, this is the first time that the fiat currency system is tested with, an inflationary environment while we have this much debt in the system, and real interest rates are this low. So the last time we went through this was like the 40s in the developed world, the 20s, 30s, and 40s. And back then they had a gold peg, and so a lot of them had to break their gold peg, but then they reestablished their gold peg at a lower level, and eventually, of course, transitioned to the Bretton Woods system. And so they still had a tether to commodity-based money. Whereas now we're going through a similar phenomenon, but in a purely fiat currency regime. And so there are a lot of big questions about how they're going to navigate this. And one of my overall views is that basically I would position for hyperinflation similar to how I position for inflation anyway. And so my overall view is basically have hard, scarce assets, productive assets or good monetary goods. So some people, they prefer gold, some people prefer Bitcoin, some people prefer a mix of both. So those combinations of, say, commodity producers, hard assets, good real estate, and then good monies is the protection either way against a full range of kind of inflationary scenarios. Whereas if you get into extreme inflation or hyperinflation, then you also have to consider personal security, kind of prepping type of mindset. Basically, have resources available so that as kind of society goes through very difficult periods, that you're positioned to kind of meet your basic needs for a decent period of time if you have to, if you have a pretty severe breakdown in supply chains, and some of these other kind of shortages.
You said, I think it was one of your tweets, you said this is more like the 40s than the 70s. What did you mean by that?
So that goes back to the idea of the long-term debt cycle. So in the 70s, they had actually already inflated away a lot of the debt from the 40s, and going into the 70s. And so in the 1970s, the issue was there were a couple of issues. One is that the United States did not have enough gold to back the Bretton Woods system anymore. That had been building up for decades. It wasn't like by the time 1971 came, they already messed up. There were already too many dollars outstanding compared to how much gold they had, and so the system was unsustainable. And so that system broke. In addition, energy production, oil and gas production in the United States peaked. And so the United States became more reliant on importing oil and gas. And of course, you had oil embargoes and political issues like that. And so basically, that combination of devaluing the currency, defaulting on the gold standard, devaluing the currency, combined with real resource constraints, basically lack of energy, created a very fertile ground for inflation. And the only saving grace was that debt as a percentage of GDP was very, very low throughout the developed world. Because they had already inflated a lot of that away. Bonds were already considered, certificates of confiscation. And so valuations were low, debts were low, both public and private. And so in the U.S., Federal Chairman Paul Volcker was able to come in and say, well, we're going to jack interest rates up to 20%. We're gonna maintain confidence in the system. We're going to put real interest rates back into positive territory, and we're going to show the world that we mean business about stabilizing this, even if it means putting the U.S. and other parts of the world in a recession and hurting that demand, in order to kind of cool off some of that inflation and use their kind of top-down approach. And so that kind of set the stage for 40 years of more stable policy because they kind of built confidence in that system. Now, if we go back to the 40s, the big difference was that was kind of the during and the aftermath of World War II, and so the developed world had tremendous debts as a percentage of GDP, especially on their sovereign entities, so the governments. And so when fiscal spending is that high and sovereign debt is that high as a percentage of GDP, then even when they got inflation, they said, well, we can't raise rates because then the government itself is insolvent. And so what they did was they held rates low, even though inflation ran hot. And so that's how the 40s were different than the 70s. Basically, there were a different set of constraints there. So even as denominated in their own currency, their debt as a percentage of GDP was very high. So their only choice was to partially inflate it away. And so back then, they were able to thread that needle where they were able to inflate it away without hyperinflating it away. And so the United States devalued. If you were holding treasury bills or treasury bonds in the United States, you lost 30 to 40% of your purchasing power over a decade. If you were in most European countries, it was worse because the countries were more damaged by the wars, including countries on the winning side, like France and the UK, let alone countries on the side that sustained more damage. And so those currency devaluations were often even more severe, but most of them avoided hyperinflation. And so, but it was still a very traumatic event for currencies. And there was no guarantee that they would be able to thread that needle. It's possible that more countries could have hyperinflated if things worked out differently. And so that's kind of the big difference between the 40s and the 70s is that debt is so high in the system that everybody expects the Fed to tighten and kind of try to rein in inflation, whereas they're kind of constrained from doing that because of how they've, because of their policies over the past few decades that kind of encouraged all that debt accumulation in the first place. They kind of built this bubble that now they're trapped under.
So the bondholders and the peasants are going to be paying off the debt for them through inflation.
Generally, yeah, if people holding bonds or cash historically in this sort of environment are the ones that end up paying a lot of that. Um, and so it's obviously also damaging for people on fixed incomes.
Yeah.
And beneficiaries are generally people that own hard assets, people that have, say, debtors, right? And so, for example, like in say the 70s when you had high inflation, basically anyone who held real estate did very well because you had this fixed rate mortgage and you had real estate and the real estate appreciated. And so there's kind of winners and losers across the income spectrum, but the general theme is that cash and bondholders take the big hit, and debtors and those holding scarce assets generally do pretty well as long as their debt is not structured so that they are at risk of liquidations, because you can have a very volatile event like there's, I believe it was Dan Oliver had this chart and I heard about it because of Luke Groman, that they showed gold in the Weimar Republic, the price of gold in marks, and of course it went to like infinity more or less, because the currency hyperinflated, but it wasn't a straight line. And so if you had callable debt, there were multiple 80% drawdowns in gold during that passage, because there were periods of time where German officials made it look like they were going to stabilize the currency, and they kind of reined it in for a little bit of time, but then it broke again, and so gold would have another huge leg up, and then it would correct. And so the key is to have long denominated debt, like a mortgage, or like say how Michael Saylor's tried to construct his balance sheet, rather than that type of the short term leverage that is callable. And so or just put leverage aside and not use it, but just have kind of those real assets that whenever the dust settles and people have to kind of reconstruct a new system, that you have things of value that people will want back in the future. It could be money, could be productive assets, good, like hard goods.
It sounds like it would be bad for pensions as well, though, because they tend to hold bonds, right?
Yeah, it would be not good for most pensions. And the tricky part for them is because they have to meet these target return expectations, but they also have to minimize volatility. And so historically, they've held a pretty good amount of bonds. And so it's also, I mean, if you look at, say, investors in Europe, they tend to have more bond heavy portfolios. It's just been a big kind of facet there. And so yeah, there's large pools of capital that would be very impaired by bonds doing what they did in the 40s, which is basically having negative interest rates when you factor in inflation for a lengthy period of time.
So, how's Lyn Alden preparing for this?
Well, my approach is, I like some degree of diversification. So obviously, I have a large Bitcoin allocation. I still have my gold allocation, and then I have a range of productive equities. So, oil producers, gas pipelines, some healthcare companies, some real estate companies. Basically anything that I think is producing something productive, generating positive cash flows, has a sustainable future-proof business model, and then some of them have good fixed rate long-term debt associated with their hard assets as well. And so that's kind of my overall combination. Obviously, also real estate, as long as you're not buying like bubble valuations, is a very attractive way to have exposure. And then you have, like, say, a long-term mortgage attached to it, so that you have that non-callable. It's essentially a long-term fiat currency short, essentially.
So, property, gold, Bitcoin, and productive assets.
Yeah.
Okay, I'll probably stick with property and Bitcoin. let's talk about Bitcoin. We had an all-time high a few days ago. We hit $67,000 after a really crappy mini bear market. I was pretty happy with that. I'm sure you're pretty happy with that, as you've just said. You have a large allocation towards it. Feels like Bitcoin is maturing very, very fast this year. With we have the ETFs. I know they're futures ETFs, and we should probably talk about those because I'm sure you've got a view on that. Because some people were very positive for them, some people said they were negative, but it feels like we have a fast maturing Bitcoin market.
Yeah, I mean, over the past couple of years, we've had a big insurge of institutions. So it's gone mainstream in the financial market to some extent. It's still a very small allocation among retail and among institutional portfolios, but at least it's not like considered a joke asset anymore like it was years ago. And so there's a lot of interest in that space, obviously. And then the Bitcoin ETFs kind of signal a few things. One, I mean, they've already existed in other countries, and so one of the long-term, say, risks or FUDs, depending on how you want to look at it, that people have around Bitcoin is, what if it's banned? And so the SEC coming out and approving Bitcoin ETFs, and we've also had, say, the Fed chairman says there's no intention of banning cryptocurrencies. Basically, some of these large pools of capital want more regulatory clarity, and so that helps them when they see that. And so there are many of us that cared less about regulatory clarity, and we want to own good assets, so we bought that ahead of time. But there are other pools of capital that they want to see that SEC approval to some extent. Now, I mean, I personally don't like futures-based commodity ETFs. So these existed for oil. These have existed for agricultural products. I'm not a fan of them, and that would apply to Bitcoin as well. So I'd rather have, if they're going to have an ETF, I'd rather have them have a spot ETF where they actually hold the Bitcoin in cold storage. Now, you still have counterparty risk. You still have other issues like that. But at least that kind of ETF should track the price pretty well. And for investors that want to hold it in a brokerage account, either because it's an IRA or it's because they just they have assets in that account, that that's the institution they feel comfortable holding with. I would at least prefer to see a spot Bitcoin ETF, which again you see in some other countries, but the United States so far is kind of been improving this futures based route, which I think is in the long run not going to be very beneficial for shareholders.
Do you think it's just a test though ahead
You
of
know, it
it?
might be. Yeah. There's different ways. So some of the issues with spot ETFs is that, in theory, you can have those like, those crazy candles where, you have an issue on an exchange and suddenly like, Bitcoin is kind of, spikes down in price and then comes back up. So I think they're worried about things like that, whereas futures are a more regulated market. But the problem is that futures don't track the underlying Bitcoin, and you kind of bleed out some of your capital by rolling those futures over time. And so it is possible this is like a test. The more conspiracy route is basically that if you have a large enough futures market over a spot commodity market, it is a way to kind of potentially influence the price a little bit or even suppress the price a little bit. So that's one of the more things that some of the people are concerned about. Um, Overall, I'd like to see, for example, Grayscale eventually convert into a Bitcoin ETF, and they obviously have plans for that. So overall, definitely a spot ETF would be better. I think obviously people should at least consider self-custodying where possible. But if you're going to have these regulated products, I do think that eventually they should move towards having a spot one as well.
And have you got a price target for the year? I know this is the question everyone hates. And uh, is there any chance that you might scale out of Bitcoin at some point if prices get to a certain point, or you are a 10-year, multi-decade Bitcoin hodler?
So I plan to hold my allocation for the very long term. I don't plan on selling any cold storage Bitcoin. I have I have a little bit of GBTC. I have a little bit of minor equities. I would consider selling them or trimming them in a parabolic spike and kind of, allocating a little bit differently. But the cold storage Bitcoin is not something I plan on touching. As for price targets, I mean, I tend to avoid specific kind of, 1 quarter or 2 quarter price targets. That's more of a trading call than like a macro investor kind of framework call. I am on record saying that I wouldn't. So, when last year in 2020, when Bitcoin's market cap was maybe a third of a trillion, I was on record saying I think it could hit over a trillion, and so we crossed that mark. And then once it did there, I said, well, I certainly could see over 100,000, by the end of this year. Now, obviously, we've been in a correction for a while. I still think that's on the table. It could be 2022. I don't have a strong opinion about timing. That's more of a trading call. But overall, I'm still very bullish long term. So that's kind of my main focus, is that it's an asset that I want to hold for many years, rather than something I want to focus on. What is the quarter by quarter price target of it? But I do think that a six-figure price target is eventually in the cards.
Yeah, and especially with what we spoke about happening over the next decade, very kind of uncertain times with inflation, Bitcoin is one of those things you want to hold. So yeah, and no, I have no plans to touch my deep cold storage either. Okay, one thing to finish on today. Can we talk about Aikido?
Sure.
I loved that tweet thread. I read it and I was like, oh, yeah, do you know what? You're so right. Because I give airtime to people who can be dicks, and I shouldn't. But I really like that thread.
Yeah, basically, so for people that aren't aware of that thread, I just kind of put out, I have experience with martial arts, and you know, mine were the more traditional styles, like what we know of MMA today. So kickboxing, jujitsu, submission grappling, that sort of thing. But we also learned, we had these kind of traditional karate, traditional jujitsu, traditional kind of aikido aspects that we kind of were least familiar with. And the whole point of aikido is to use your enemy's energy against them. And so, it's something that I would think about when I'm in, say, a sparring match, right? Is that if I'm against a smaller opponent or a similar size opponent, then I can rely on my strength or my speed. But if I'm against a larger opponent, my strength is less of an asset, and it's more about speed and then trying to figure out how to use their own momentum against them. And the example I use, if I'm sparring against say a larger, like a man, because it was a co-ed martial arts school, is I would do this thing where I'd push against them really hard, and then, eventually they'd push back and overpower me, but I was kind of waiting for that moment, and I would instead like grab them and pull them down. And so it's mostly their own forces now, kind of, they use that surge to, counteract my pushing, but now I'm just kind of pulling them. And so on Twitter and online debates in general, instead of kind of coming out and saying like, you're an idiot, or like you're dumb, or like, I kind of try to be I try to let people kind of hang themselves, you could say. Like I let people be their own worst enemy and just try to stay polite and engage them and still kind of push back on points I disagree with. And so I was just kind of putting out my philosophy a little bit as it relates to online communication because I feel like a lot of people are different people online versus offline. And I think it'd be a lot easier for a lot of people if they still acted online in a similar way that they act offline. At least in most ways. So you still kind of, you focus on, you can still say when you disagree with something, you can still be super honest, but just kind of realize that sometimes the best outcome is when you're calm and your opponent is the one that's this, kind of freaking out, looking like an idiot, getting aggressive. It doesn't really work out that well for them.
There's a great thread. I'm going to include it in the show notes so people can read it. Well, listen, Len, lovely to see you again. Like I said, I missed you last month, so I think everyone missed you. I got a few emails. So I was like, "When's Lynn back? Is she
Yes.
gone?" I was like, "No, she'll be back soon." But it's great to have you back. Great to see you. Your Twitter's been on fire recently. You are subtly quite savage at times, especially with people like Professor Plum, and I love it. I love to see it. So yeah, great to see you back, and we'll see you again very shortly.
Yep. So we'll see how this goes. Hopefully, it's a decent quarter. And thanks for having me back on your show. Always happy to be here.
Brilliant. Thanks, Lynn. Take care.